Welcome back to our Wealthy Wednesdays with the Property Queens. Today we are going to talk all about the market update, things that we have seen in 2019 and things that we predict in our personal opinion that could be happening on to 2020. Also what we are seeing currently in today. So one thing that's really great that's happening right now in this day and age in January 2020 is that we are seeing interest rates are still really low, at a record low, and there's indicators that they're still might even going to stay where they're at, or there could be indicators that it could even be going lower, which is great for buyers because it just means that you can pay less interest on the money that you are borrowing to buy. So that's all great news. Also, I was talking to a lender the other day that January has been, at least in Nashville, it's obviously market to market is different, but here in Nashville, we are seeing January as comparing Januaries. In the last 4 Januaries, this has actually been one of the best Januaries for pre-approvals. It's been record high. It has been busy. So far starting out, it is starting out really good.
So let's talk about how we got here, what 2019 looked like. Overall, it was a great year for the markets, pretty much across the board. Commodities did well, large cap, mid cap, small cap, really across all industries, performed really well last year. And the market's been doing pretty well for the last few years. So what does that look like going forward? We don't know for certain, but we've seen a few years of really, really high growth.
Yes.
So typically when we see that type of growth can't continue forever, but 2019 looked great. That was helped by interest rates being low. We touched on that. They are still very low, but the Fed kept interest rates low last year, which gives everyone easier access to money. Money's cheap to get. People are spending a lot more. That really helps grow the economy, which is what happened in 2019. A few factors that helped 2019 last year's performance were in the fourth quarter, the U.S.-Chinese trade war. Things were smooth over there. That helped the market. We did see some political volatility, but in the end, it all worked out okay. Markets again were up. So one thing you guys probably heard about last year was Brexit. That was a big buzzword throughout the news channels, and that ended up being a lot smoother, did not cause as much volatility in the market as was expected. So again, leading to market highs last year. There were a lot of international conversations, especially towards the end of the year. But even with all of the political unrest in certain areas and international tensions, the year was still great overall.
It really was, yeah.
Good year. Even with last year being a great year in the markets, interest rates being at pretty much all-time lows, markets being at all-time highs, corporate earnings were still relatively lower than expected.
All right, so touching on that, currently companies are facing an extremely difficult labor market. So it would be hard for them to reaccelerate growth without any sort of meaningful trigger or some type of growth in the global economy itself.
And that's right, because even with the market at really all-time highs last year and low interest rates, corporate earnings were still pretty low given the circumstances.
Yeah,
that was due to the labor market.
Yes, those in the market, they believe that going forward this year, earnings growth will be at 9% compared to last year, which dipped down to 2%. So this year's outlook looks relatively good compared to that. Yeah. All right. So for 2020, we have seen falling interest rates, including a boost in the housing economy just because of the low interest rates. And then on top of that, debt servicing has been made more manageable. So that is really good and does boost the economy as well and help with housing because if someone has a credit card and a mortgage, it's more manageable. And then just in terms of outlook on 2020, if this year, growth can reaccelerate, it will be a much higher earnings margin, I guess, for everyone.
So it's hard to really kind of give too much credit because there is a lot of moving parts right now going on. Obviously, the election's going on. There's also talk about war. There's so many different things that could potentially affect the market and things like that. So all of that is needed to take in consideration. And there's so many different websites and things you can do on your own, like looking at, if you're talking about real estate, looking at days on market, looking at inventory, things like that, to kind of look at indicators that could be a prediction of what is to come in the following months of this year. So with all that being said, it could mean that there is a volatile market coming our way, which is great for investors because honestly, back in when the crash did happen, not saying that that is what we are predicting, but when that happened is what created most of the millionaires in the real estate market because they were able to buy low and ride that wave up. So, you know, a lot of people get scared about, oh, there could be a recession, there could be a correction, there could be a crash, all those different things. And, you know, it's just a matter of looking at things differently, right? So it's great for investors. This means you guys should just think outside of the box, right? So a volatile market brings a lot of opportunity to make money in this market. So it means that you can, once again, like I said, ride that wave up. Start focusing, instead of like buying primaries, start buying more rental income, apartment complexes, things like that, that you know people are going to need rentals. You know, people are going to, you know, you can buy low in that market if it's volatile and it gets to that point. And then you can ride and get that equity back up as it climbs back up. Because the thing about real estate, which is amazing and which is why it's one of my favorite investments, is people always need a roof over the head. So no matter what, it's always going to pretty much go back up. So even if it goes low, no matter how low it goes, it's always going to go back up. It's like it's just a cycle. Just make sure you guys are keeping well-diversified portfolios and long-term objectives if that is how our market shifts. So no need to get alarmed, no need to get freaked out, because a lot of people hear the word recession, crash, things like that, and they just get freaked out. There's no need for that. There's always opportunity in every market we're in, whether it's buyers, sellers, whatever market we're in. You just gotta follow the trend and know how to take advantage of whatever market that we are in.
Plan ahead, especially if you're planning ahead and you buy a rental property. Just think that if there were a crash, then there's going to be a shift from people buying homes to wanting to rent. So you're going to have this huge pool of renters that need a place to stay. And if you're one of those that bought rental properties, then you're going to be making that money during that time. So that should be one of your long-term objectives, like Shannon was saying, going forward. Get real estate that makes money for you.
Exactly. And it is easy to get emotional when we see moves in the market, whether it's equity market, real estate market, but focusing on your long-term goals and your long-term plan helps to take that emotion out of it.
Yeah.
And I would just like to thank Insider Sources. We use Forbes, Bloomberg, Washington Post, and Fidelity Investments. And thank you for watching this Wealthy Wednesday with the Property Queens. Please make sure you like, subscribe, and share this video. And see you next Wednesday.
Bye.